Hi, everyone. Welcome again to another edition of Coleman Wealth Home Office Edition. I've actually snuck into my office in Toronto because someone has to check the mail every once in a while. And I want to point out, Doug Ford said I am essential, so I'm allowed to do this from time to time. Today, I'm joined by an old friend, Dennis Mitchell, who some of you, if you're an avid BNN Bloomberg watcher, you've seen Dennis many, many times. Dennis is one of Canada's preeminent, probably most experienced real estate and infrastructure investors. Dennis, you're the CEO and Chief Investment Officer for Starlight Investments. No, excuse me, that's not right. I'll change that. Starlight Capital. I got to get all my words correct here, but that's part of Starlight Investments, which I think is an interesting story. So would you mind just taking that up and kind of introducing yourself and the role that you play in the company that you that manage and work for?
Sure, and thank you again for this opportunity, Darren. Starlight Investments is our parent. Starlight Investments is a $14 billion real estate asset management firm operating across North America. There's over 40,000 apartment suites that we own and operate across Canada, another 14,000 plus across the United States, and we own and operate about 7 million square feet of commercial office space across Canada. Now, Starlight Capital is the fourth business underneath the Starlight Investments umbrella, and it is my honor to serve as Chief Executive Officer and Chief Investment Officer of that firm. And we are focused on operating and managing portfolios of listed global real estate and global infrastructure securities.
So one part of the business is one of the largest landlords in the country, if not North America. And then you run the public entities, so you trade within the financial markets in similar type securities.
Exactly.
Kind of have insight into your world of publicly traded, but then the company has insight into the actual operations and management, which I think actually is an interesting dynamic. You guys have the ability to access information and use information because of that insight, don't you? That I think most people wouldn't have access to.
Absolutely, Darren. It's one of our key competitive advantages. Being a subsidiary of such a large real estate asset management firm means that we do get insight into what's happening directly on the ground in real estate markets, and not just specifically in the operations of the properties, which is valuable, but also what's happening in the financing markets, specifically the debt capital markets around, say, real estate. So it does give us valuable insight. And at a time like this, that insight matters because we can see trends before they get reported. And so we can see and act on trends before our competitors are even aware of them happening. So that's a huge competitive advantage that we have.
Now, I think that is, you're in a very good spot to be able to use that information, but you've also got a lengthy history as a real estate investor. And I think it's kind of fun to point out that you and I met back in 2009, the last time we had a big financial crisis and real estate went massively on sale. At that time, you were running what was one of the only, if not the only, REIT fund in Canada, or fund focused on REITs for Century Investments. You and I met back then when it was probably a bit of a struggle to raise capital in a market that no one was at all in love with. But that worked out brilliantly for our clients and us. We had a great ride as the world kind of returned to normal. It also worked out for you because you went from running this little kind of REIT fund to running the entire place after a while. So I had the success of that. But I also think that speaks to your perspective as an investor, because I look at you as a really wise investor, and not just in the real estate space, but the way you think about businesses and cash flows. I love the philosophy that you have. Would you mind just taking us through a little bit about how you think about allocating money and what a good investment looks like?
Yeah, and so we see ourselves as allocators of capital to businesses, and it's very much in the mold of what Warren Buffett does and how he approaches investing. But we try to run concentrated portfolios of high quality businesses that we can acquire when they offer us enough return for the risk that we're exposed to. So when you parcel that out, a concentrated portfolio means we're trying to buy between 25 and 45 companies. To us, it doesn't make any sense to put money into your 60th or 70th best idea. And quite honestly, some of our competitors own as many as 200 and 300 securities. I would argue companies 200 to 300 aren't adding a ton of value to the portfolio, and it's tough to stay on top of them. And then when we talk about high quality businesses, we're looking for four things, Darren. We're looking for strong recurring free cash flow from a portfolio of irreplaceable assets that have been capitalized with low debt and are run by management teams that behave like owners and treat us, the investor, like partners. When we find a business with those four attributes, that's when we finally open up the spreadsheets and start digging into the numbers to figure out what can we expect in terms of total returns going forward. So not just capital appreciation, but also cash flows and distributions and dividends paid out to us. That's when we start looking at what can we expect in terms of total returns. But importantly, we also look at the risks tied to those cash flows. And we do that when we make the investment. It's interesting that people understand intuitively when you buy a house, you get insurance so that if it burns down, you're covered. If you buy a car, you get insurance. If you get into an accident, you're covered. It's only with publicly traded securities that people buy the asset and then they only worry about risk when markets get volatile like this.
Right.
We look at risk as the potential for the permanent loss of capital. And so when we talk about mitigating risk, we talk about only investing in great businesses, only investing in industries that we understand, and then only purchasing when we can buy them at a discount to what they're worth. So that when time periods like this come upon us, or as you pointed out, 2008, 2009, we already know that our businesses are resilient and can survive. And so really we've stolen a march on our competition, if you will, and we have the ability to add more as our names get cheaper and our investors benefit from that. So in a nutshell, that's how we look at investing in publicly traded securities, regardless of whether it's real estate or infrastructure.
Now, I think, by the way, our conversation today is going to be kind of limited, but you and I did a much longer conversation for CAASA, which is the Canadian Association of Alternative Strategies and Assets. You and I did a podcast together for them, which to our credit is apparently the most popular podcast in their series. It's all me. It's all me. That's why I partnered with you to do it. So congratulations to us. So I'm going to put a link in the description if people want to listen to that longer conversation where we're going into more detail. But one of the things that I want to jump on is the fact that you think about things like real estate. Most people intuitively understand. A lot of them, investors in real estate, are a little worried because the world does look strange now. You know, maybe there's 3 of us in my entire office tower downtown at the moment. The place is like a zombie movie. It's very weird down here. All the malls are closed, so retail is in a struggling place. But is that picking up value for you, or do you have other places that you kind of move to that are doing well in this environment? Like, how should people think about real estate in their portfolios right now?
Sure. And whether it's real estate or infrastructure or healthcare or technology, what you want to do is you want to invest in businesses that are going to be resilient during this downturn. And then on the other side of this, whenever we get out of this COVID-19 pandemic, are poised to continue to excel. And so we're interested in businesses that have structural long-term drivers, things that are driven by population growth or 5G or e-gaming or social media. And at first glance, when you look at real estate, you wouldn't think that that's a sector that is driven by those long-term structural drivers, but in fact it is. And so when you look at the sectors that we've chosen to allocate our capital to, residential, industrial, cell towers, data centers, you can quickly see that the structural trends towards online shopping, towards social media, e-gaming, data storage, 5G communications, all of these, and immigration, of course, all of these long-term structural drivers drive the occupancy and utilization of the real estate entities that we invest in, and that existed before the pandemic. We're seeing that those structural drivers are making these sectors and businesses resilient during the pandemic, and then when we emerge on the other side, these companies and businesses are already poised to continue their long-term outperformance, regardless of how the pandemic winds up.
You also think about infrastructure, just to move to that wider perspective. You guys have a different view of that than I think a lot of people might expect, right? I think many people, when they hear infrastructure, they think, well, toll roads, airports, that kind of stuff, which are actually struggling right now because not as many people are using them. But you've got a wider view of infrastructure, don't you? Like Visa is one illustration that, if you wouldn't mind taking us through how that you see as an infrastructure.
Sure, and that's an excellent example of an emerging class of infrastructure that we call infra tech. Okay, and what that is it's infrastructure businesses that are really driven by technology. So Visa is one of the 4 dominant payment networks on the planet. And our test for infrastructure, our definition of infrastructure are businesses that provide an essential service in a supply-constrained manner to a large portion of the population. And it's usually an easy test. If you ask somebody, can you get through the day without drinking water? Most people will say no, right? Using electricity, no. When you get down to other industries like payment networks, you ask people, can you get through the day without using your Visa? And sometimes people will think, well, maybe, but then you remind them of the things they have that go through passively, like subscription, memberships, right? The newspaper, gym, your Microsoft subscription. And so people begin to realize that above and beyond the things that they overtly use it for. You go to the store, you tap your card or you swipe or what have you. There are things running in the background that they've set up that automatically run through. And so when you look at the global payments network, it's dominated by 4 businesses: Visa, MasterCard, American Express, Discover Card. They operate in an oligopoly. They generate outsized returns, and they are increasingly an essential service. And Visa is one example. But then you start looking at high-speed internet. And I think most of us now today, whether we deal directly in technology or if we're in healthcare or financial services or even the teaching profession, given where we are these days,
Right.
most of us can't operate without high-speed internet. And the reason I say this is an emerging sort of class, this infra tech, is because, quite honestly, 30 years ago, high-speed internet didn't exist. Right? I mean, all of us were on dial-up and had to listen to that annoying sound every time we wanted to access the internet. Well, now you fast forward 30 years and it's become an essential service. So these industries that aren't traditional infrastructure are increasingly emerging in this infra tech category. And it includes things like data centers, cell towers. And so it's an interesting, unique subset of infrastructure that we've chosen to really highlight and allocate meaningful capital to. And it's really, really been a source of value add for our infrastructure fund, going back to its inception, but certainly year to date during this pandemic. As
Right.
we're doing this, over technology, more and, you and I did a previous one for CAASA. I've done a ton of these calls pretty much every day, every week since we've been in lockdown. You can see the demand for telecommunications, all of this information. You're going to host this, you said, and push it out on YouTube.
Yeah.
Well, that has to be hosted on a server somewhere. You can imagine how many people are interacting in this manner, so you can see the demand for storage and hosting. All of these services, not only was there a structural driver before the pandemic, but you can see how the pandemic has driven a spike.
Accelerated.
Short-term utilization.
Faster, right? And I think that's an interesting part about when you guys allocate, you're not stuck in one spot, right? That's one of the challenges. It's interesting, before we get into this, a lot of talk about indexes and ETFs and other things, but those are very much driven by an algorithm. They don't have anyone thinking about where to move and adjust. So
Correct.
This is a great example of how the world changed on us in just a matter of 6 or 8 weeks. And the office towers are empty, the malls are all empty. But I'll tell you, if you didn't have an Amazon account 3 months ago, you have one now for sure. And
Yep.
And everyone asks me how we're doing at home. I'm like, we're fine. But if the Wi-Fi goes down, I don't know what's going to happen, because the kids got to
Darren,
learn to read a
stat,
book or
here's
something.
the stat for you. In the United States, in the month of April, there were 40 million first-time online shoppers. 40 million.
Wow.
So that is a perfect example of the pandemic driving a spike in short-term utilization for something that was already a structural driver. Retail sales in the United States grew by 3% last year, but online sales grew by 15%. So there was already a structural trend, but you can see how the pandemic caused that trend to spike. And I mean, between you and I'm going to go way out on a limb here and say that when we're done with the pandemic, more and more people are going to continue to shop online for things. You can quote me on that. We'll come back a year from now and see if I'm right.
I'm not even, there's no wagering for those at home. There's no wagering. I actually think you're right, because as soon as people begin to experience that, they don't really go back. They may want to go get things at the mall, but at the end of the day, once that truck shows up, I see that guy more than my wife probably. The door. No, it's probably the way around, which I'm going to edit that out because that got weird in a hurry. Anyway, but yeah, you're right. Those trends are accelerating, and that's one of the benefits of using an active manager in this space, is that as things move, you guys can adjust. And I want to use the word pivot, but that's getting a lot of play right now. So maybe I will take pivot out of my vocabulary. One of the things that's also interesting are some of the structures that you guys have created to allow us to access the investment management services. So you guys have mutual funds. You also have ETFs. So you're fairly agnostic on the box the investment comes in. And we're active users of those in our models and in my pooled fund. You also are just in the midst of launching another suite of pools. Do you want to take us through what those are and how they're different than the things you already have on the shelf? So I think this is an interesting enhancement to what you do.
For sure, and it's very timely as we're rolling those pools out now, as we speak. So when we initially launched Starlight Capital, we saw a niche for a specialist real assets manager who would be able to bring not just listed securities to Canadian retail investors, but also private investments in real assets, infrastructure and real estate. So our funds, of course, we launched in 2018, and those, most people are surprised to know that we can invest up to 10% in private solutions in the funds and the ETFs. So that's one option. We launched other solutions that were 60% listed and 40% private. But as we speak, we're launching the Starlight private pools, one for real estate and one for infrastructure. And these solutions are up to 80% private investments. And we using the benefit of the relationships we've built globally over the last 15 to 20 years, myself and my team have struck relationships with best-in-class private asset managers across the globe, whether it be Canada, the US, Europe, or even into Asia. And we now have these opportunities to allocate to their exclusive solutions to give Canadian investors exposure to real assets on the private side globally. And the important thing here is that we're expanding the universe and the investable universe for Canadian retail investors. We're giving them exposure to asset classes and sectors that don't exist in Canada. And we're giving it to them shoulder to shoulder with some of the biggest institutional investors in the world. We're talking about Fidelity, RBC, Blackstone, Hoop, Teachers. And so standing shoulder to shoulder with those types of investors in exclusive solutions that are not available to Canadian investors, that's how we expand the addressable universe. And that's how we partner with advisors like yourself, Darren, to bring the world of real assets to Canadian investors. So as you can tell from my voice, I'm super excited about this opportunity and this launch, and I can't wait to speak to more investors about the unique solutions that we're bringing to this universe.
Well, I know we've been talking to you about it kind of even before, like as it's been moving along to get it to the public and for us to be able to access it. And I'm very excited by it because it does allow our clients to participate in investments that have almost always been off limits to all but the wealthiest and generally only institutional investors like pension plans and other massive pools of capital have, because the rich always get richer, as they say, right? So this allows us, I like that shoulder to shoulder analogy. Well, listen, I'm going to thank you for your time today. I wanted to keep this pretty tight and pretty crisp. And again, people can listen to our longer conversation that we had on the CAASA podcast. And you and I can talk maybe again as this pandemic unfolds and as things twist and turn a little bit. I appreciate our friendship. I'm glad you're still around running money for us because you probably made enough you don't need to anymore. But I'll tell you what, and I say to clients, like you and I met the last time we had a big pandemic, and you did a great job for clients back then. And if I made any mistakes back then, it was not giving you enough money in 2009. So,
well, learn from your mistake, Darren. Don't make that mistake again.
Well, listen, thank you, Dennis, and I appreciate your time as always. And for all of you that tuned in, thank you very much for watching, and we'll see you again. Stay safe. 6 feet apart from everybody, one hockey stick.
Thanks, Darren. Stay safe.